Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, April 5th, 2022. Welcome back on the podcast, George.
Hey, John. Good to be back.
Yeah, good to have you. And you know, as has been the case this year, plenty to talk about. And you know, George, let me start off by wishing you a happy new fiscal year. You know, for those unfamiliar, Japan operates on a fiscal year that ends at the end of March. So we're just 5 days or so into the fiscal year in Japan. And George, on that topic, you've been spending some time reviewing investment patterns, around Japanese investor flows, in and out of foreign bond markets. I'm curious, what you found and what you can share with our listeners.
Absolutely, and happy New Year to you as well and everyone else. I do think that it is a fascinating time starting a new year after one of the worst quarters in the bond market, as I think we all know. I think actually is one of the worst, if not the worst, as we've been saying numerous times. And it doesn't feel like it's getting any better given the price action that we've seen so far in the first couple of sessions. And it's also, of course, a new quarter for the rest of the world as well. And like I think that backdrop is so important, especially as Japan gets on its way. I've been looking at these patterns for many years, and it went back and looked at the data. This is all public data. Looking at the MOF data. Looking at the TIC data, there are some some patterns that can happen at times at the start or the end of a Japan fiscal year and the start of a new year, either de-risking that takes place before the closing of the books, and then a kind of rethinking about investment strategies going forward as the new year starts. I think this year, will be different, like it is like every other year, but I think the backdrop of the sort of really tough Q1 and which would be the Q4 for Japan, and just markets that are so volatile still. Judging by past patterns, whenever we do see markets this volatile and really no clear trends, Japan does not really jump into the fray and try to drive the price action. And so I think it's early days, but just looking back historically at patterns, what we've found is there's more of a two-way opportunistic sort of behavior, especially if you look on a cumulative basis for their treasury holdings, where once they get into a buy or sell program, that those sort of trends continue. There's less of that when it comes to mortgages. On the treasury side, Japan was, although always a super critical and important participant for the U.S. rates markets, their flows have not been as big as they were, let's say, in 2010 or even during the 2003 or so FX interventions. Really since the reach for yield in 2016, 2017, the Japan flows and treasuries have been pale in comparison to what how high it's gotten in the past. And so Japan obviously important for U.S. rates markets more on a two-way kind of basis. And where it's really interesting, Japan flows are their involvement in the mortgage market, overall credit, and then equities. And there we're also seeing some interesting patterns develop as well. And where you whenever and those three categories really valuations drive things more so than just outright kind of where to place your money or dollars. And if you look at the activities around the mortgage market, whenever we get basis really rich or really cheap, that's when Japan starts to get more interested or starts to change their behavior. And given that there's really no clear sign of where the basis is going to be, if it's really topped out yet or not, I also think that again, starting the new year, I'm not sure they're going to be the first movers to try to come in and really be super supportive. Again, this is all just looking at patterns from the data, things that I've been looking at and sharing as well. So we'll see. Obviously, this is just historical accounts, but based on my kind of intuition of how this has unfolded, I think that the first couple of weeks of this new year, the markets have to stabilize before Japan gets really involved, I think, in my opinion. And then, what was also very interesting in the most recent data, both in the MOF data as well as in the TIC data. For the better part of like the last 6 months or so, there's been a decent amount of shedding of equity exposure. But if you and you can see that from the TIC data, and then if you look at it from the MOF data, there's less. There's an initial kind of decline in equity buying or actually outright selling of equities, of foreign equities. So it could be U.S. and European. But if you kind of try to reconcile the TIC, which is just U.S. data, U.S. equity ownership, relative to the MOF, which is global, it looks like perhaps there was some sort of diversification away from U.S. equities over the last 6 months and into other markets, perhaps maybe Europe. I don't know. But it would have to be a really big market to absorb that sort of flow. So a lot of interesting nuggets of information. Plan to have more on that later, but I'll stop there.
Yeah, thanks, George. That's super helpful and really fascinating. And I would add to, what you said about, Japan may need some stability, before they get involved. I think that resonates a lot with me. And I think we're going to get the MOF data for March, I believe, on the 8th, so just in a few days. And if the data comes out as we think, it's quite possible that the fiscal year 2021 will be the first year since 2013 where Japan has sold both foreign stocks and foreign bonds, on the year, so that'll be fascinating. So, perhaps if and when markets stabilize, they'll have some dry powder to deploy. But to move on, as a reminder for our listeners, we're recording this podcast on Tuesday, April 5th. This is one day before we get the minutes from the March FOMC meeting. As our listeners may recall, that's the meeting where the Fed, in fact, raised rates for the first time this cycle. But also in the press conference, this is where Chair Powell told us, he was vocal, that we should learn more about the Fed's balance sheet policies in these minutes. He said that since then. And today we heard from another Fed official, Governor Brainerd, where she mentioned that the balance sheet will likely shrink much faster versus the last time the Fed embarked on quantitative tightening, also known as QT. So, George, take us through these developments and your expectations.
Well, that's a lot to unpack there, and it's and the Fed's balance sheet's also very hard to unpack as well. It's become ginormous to for lack of a better word, the Fed's balance sheet, but basically around 9 trillion. And, I think, those have been listeners as well as readers of my content, over the years. I mean, especially over the last year and a half, we'll recall that I think many others share the same view that the Fed, over-eased and did too much QE, and now they're going to have to do QT and actually try to shrink the balance sheet and not just, expand it, which they've done in great size. Look, I think we have to take the Fed at its word. I mean, especially Chair Powell has been pretty clear and transparent about they have to shrink the balance sheet. There's just way too much liquidity in the system. That's clearly evident in the RRP, the reverse repo program, mopping up close to 2 trillion at times of dollars out there, and so they're going to have to shrink the balance sheet. And as readers and those listening will recall, and one of the big key components of my view for 2022 is that the QT is going to matter more than the rate hikes themselves, and that this financial conditions tightening is what's necessary in order to really take out some of the froth in markets, which has also led to a massive jump in wealth effect in the last 2 years during a pandemic, no less. And so I feel like the Fed's definitely going to need to shrink their balance sheet. We heard very clearly from Governor Brainerd on Tuesday the 5th that she's expecting faster. Tomorrow, which when those are listening to this podcast will be Wednesday, we're going to get the minutes, and that's where we'll hopefully get more details on how exactly they're going to shrink the balance sheet. But there's only so many different ways they can do it. I think that the substance and the nuance will probably matter more for the mortgage market, more so than for the treasury market. But nonetheless, I mean, we're going to see the Fed reverse and put bonds back into the private sector financial system, and someone's going to have to own those bonds. And so in the case of Treasury, they're going to have to issue more treasuries to replace the funding from that they lost from Fed, slowly shedding their bonds on the Treasury side. And then mortgages, the same thing. And maybe at some point the Fed might have to even sell mortgages. And so that sort of reverse of fortunes for the fixed income market which benefited primarily credit and then by extension equities through both the buyback and the overall large credit debt origination of the last 2 years. If that goes in reverse, as they're clearly suggesting, I think they will, then that's going to lead to a crowding out effect, which should put treasuries and mortgages competing against credit, and that's going to it's going to be competing for the same sort of dollars. And I think that crowding out effect will push up spreads and then eventually start to really tighten financial conditions. We got an early glimpse of that in Q1. The Fed was not as hawkish as they could have been at the March meeting. They only hiked 25 basis points. They got the process started, and then during the balance of March and into the beginning of April, credit has had a nice rebound. But I think that we're going to see multiple iterations of waves of financial conditions tightening over the course of the year as they continue to drain this excess liquidity. And I think that's going to show up in wider spreads and eventually impact equity market valuations. And I think the Fed is really really gearing towards fighting inflation. And I think what we're noticing is that whenever they mention QT or things related to the balance sheet, that has a much bigger effect than the actual hikes, which are largely priced in. So in my view, I think stands that as they embark on the QT and they do a number of larger hikes, which potentially we're going to see 50 bip hikes as well, that's going to really take the air out of financial markets into the summer. Then at some point they're going to have to make a judgment call, which has been my view all along, that they're going to have to either live with stagflation or potentially run the risk of forcing the U.S. economy into a recession.
Thanks, George. That's a great microcosm of your overall view. So thanks for sharing that with our listeners. And as a reminder to our listeners, for those of you who are not still receiving George's strategy reports directly, get in contact with him, get in contact with me, via email, Bloomberg, or on the phone. And great stuff as always. Thanks for joining us on the podcast, George.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.